3FO is more than a platform. It's the operating system of a new affiliate world. Liquid Pay Deobank, instant global remittance and on-chain savings. LFG, social trading redefined with gamification and verified performance. Protocol Yield, daily, transparent, non-custodial profit sharing. Alpha AI, the AI native financial brain, generating Ethereum yield through advanced DeFi strategies and signal mosaics. Add BTCC and your Ethereum potential multipliers. Stronger, faster, smarter. And for those who aim higher, $10 million is waiting. 3FO, built for affiliates, powered by vision.
Decentralized finance doesn't hide information. It overwhelms with it. The challenge isn't access. It's interpretation. Alpha AI restructures on-chain data into intelligible patterns. It doesn't anticipate headlines. It studies behavior. Alpha AI, intelligence for decentralized market.
General disclaimer. Welcome to this official presentation on Affiliate Marketing Model 3.0. All presenters are providing their services on a volunteer basis and are active participants in all products they are presenting. Their views and opinions do not necessarily reflect those of the organization. While we aim for accuracy, errors may occur. All content is for informational purposes only. The information provided is general and not personalized advice. We are not live losses. We provide information and systems, but we do not endorse any purchases of memberships. Your decisions are yours alone, so we advise conducting thorough research. If uncertain, seek guidance from a qualified professional. Attendees accept these terms by continuing to view this presentation. Let's explore affiliate marketing cautiously and curiously. Legal disclaimer. You are viewing an Affiliate Marketing 3.0 official presentation. All products and services, their component parts and operating methods and systems, either provided by or created by Affiliate Marketing 3.0, belong solely to Affiliate Marketing 3.0. All IPs are protected. Anyone copying, distributing, or reselling any Affiliate Marketing 3.0 product without express permission risks serious legal consequences. Any unauthorized broadcasting, live streaming, or social media sharing of Affiliate Marketing 3.0 presentations is strictly prohibited. Downloading and re-uploading presentations without permission violates copyright law and may also lead to legal consequences. Good evening, good evening, good evening. Welcome to our to day 2 of Chavez Education Day, and this is definitely not an education you want to be missing out on. So we've got plenty of space. Reach out to your teams, reach out to all of your communities, your uplines, downlines, sidelines, diagonal lines, wherever you've got people that are sitting on the sidelines and sitting on the fence, bring them along, because we've got lots and lots of exciting information that they need to hear. Yesterday's Zoom was about an hour and 45 minutes long, but it felt like about 10 minutes long. It was so interesting, and an education that is probably sold time and time again by influencers online. So this is information you are getting absolutely free. All, of course, coming to a head in the new week with a brand new product. So don't let anybody miss out. Now, quickly, before we go to Chavez, I'm going to dip to Carl. Carl's going to do a quick warning on cameras, and then we will go to Chavez to continue his education. Carl.
Joe, okay. Yesterday we had probably an accidental, but we don't want any. Just remember, if you've got your cameras on, remember we can see. So we don't want any inappropriate or accidental or deliberate photo bombing or video bombing. So be aware of what you're doing so that we don't interrupt and have any problems with Chavez going forward. And if you have missed yesterday's presentation, there is a link to the YouTube recording, so you can catch up on that. And this will be recorded and we'll have the whole set ready for anybody that's missing out. Okay, thanks, Joe. Over to you, Chavez. Let's hear what you've got today.
Hello everyone, welcome to UK Prime Time. Hope everybody is doing good. Well, it's unusual time for UK Prime Time, and we are so ready to start with episode 2 of our training. And this is a special training program that we are doing. We are going to continue this for the next 20 days till you guys get well equipped with the new product which is coming. And it is so interesting, and it will unfold slowly with trainings and upcoming episodes more and more. So if you all are ready, then let's begin with learning session 2. Perfect. So today we are going, as I said today, as we ended yesterday with the architecture of modern trading system, and I gave you all the hint where we are going to begin tomorrow, that is today, and we are going to discuss deeply about the architecture of modern trading system, how the modern trading systems are being architectured and how they are designed, and what are structured execution frameworks in trading. We were able to, I believe, establish the difference between the institutional trading and retail trading yesterday, and I believe everybody got a decent idea as to what retail traders and what professional traders are. Raise your hands if you got idea and you got understanding as to who are retail traders and what is retail trading concerned about. I mean, we discussed in length and I drew the line, the difference between retail traders and the problems which retail traders they face, along with the whole retail industry, how big is that and how big of a diaspora we can tap with a product that is going to serve in the retail trading industry. So I hope, 1 second, let me set my, okay, perfect. So let's begin today's episode, or I would say training session with a short story for you all to understand deeply what are retail traders and what basic fundamental difference is there between retail traders and professional traders. So let's imagine two people, two traders, trader A and trader B. Trader A is a retail trader and with no experience in trading, with no deep understanding in trading, with no tools, with no principle. And trader B is a professional trader who wants to professionally trade and who understands what is trading. So, and both of them start with the same amount of capital at the same market condition, and they both have access to same market, and both of them they see the same price charts. And trader A, who is a retail trader, spends hours watching YouTube videos about trading. And trader A also follows influencers on Twitter. Trader A takes trades based on intuition. But trader B does something very different. Trader B does build a system, and he defines in this system how trades are identified, the market analysis that we learned yesterday, that we understood as a basic fundamental principle of trading. So he understand the analysis of market, and after analysis of market, he defines a system in which uh, he has set a framework, he has defined how trades are identified. Then he also defines how much capital is risked, how much capital, what percentage of trade value, trade amount that he is executing is he about to risk, or he is ready to risk in the particular trade or per trade that he is executing. And then how positions are sized. So trader B is developing a system, trader B is building a system in which he is identifying the trades, he is understanding the amount of capital that is risked and how positions are sized, the size of the position, whether it is supposed to be a $10,000 position, $5,000 position, or a $100 position with 10x leverage, and how exits are being handled. Post execution of trade, it is very important and fundamental information and understanding when to exit in a trade. That is the biggest dilemma in the in when it comes to retail traders. This is the biggest confusion, biggest dilemma in retail traders. What they do, what typically retail traders do, they place a trade, then they speculate, then they do post trade analysis, and they procrastinate with the price of the market. When it goes a little down, they panic more, and in that panic, they don't sell, they keep on holding, and the price even goes down, they suffer even more loss. So, this is a typical story of a retail trader how they lose money. So, yesterday, in a nutshell, we understood the problems. We understood the problems of retail trader. We understood the reasons why retail traders they lose money. Up to 78 to 80% of the retail traders they end up losing money while trading. So in this story that we discussed about trader A and trader B, trader A trades with intuition, trader A watches YouTube, follows influencers on Twitter, but trader B builds a system. He builds a defined system in which there is systematic framework of trading, of identification, risk of capital, how positions are sized, and how exits are handled. So after 1 year, something interesting happens between these two traders, trader A and trader B. Trader A gets blown up his account. We saw blown up statistics yesterday of how retail traders they get into trading, and post 3 or 4 months of aggressive trading and trying to cover up the losses. Traders they blow up their account, then they exit, and the new traders they get into the trading platforms. That's how trading platforms they are uh, building millions of dollars of volume every single year, and they are inviting millions of users and exits at the same time. So this is the life cycle of retail trader. So in this story, trader A and trader B both have a different strategy, and trader A after 1 year gets his account blown up and exits from trading, but trader B has grown its capital steadily because he had the system, he had the whole framework of execution of trades. And with that framework, he has been able to grow his capital steadily and consistently. Now, here is the interesting part. Trader B did not predict market better. Trader B simply operated with a framework. Trader B might not have got all trades winning, while Trader A might have got more trades winning than Trader B, but at the same time, Trader A got blown up account because Trader A did not have a system, did not have a framework to trade with. And this is exactly what today's discussion is about. Modern trading is not about guessing the price direction. Modern trading is about architecture of the trading. It's all about tech. So today we will learn and understand why professional trading is systematic. So structured execution frameworks, and why structure matters in trading. It is very clear and evident after understanding the story of trader A and trader B, that and there is a very clear difference between the retail and institutional traders in the decision process, while whether to take the trade or not. Retail traders, they go with intuitions, they go with will, and then risk management, the understanding of risk management, let alone understanding the risk appetite, whether to take more than 1% risk per trade or whether to take 30 to 50% risk per trade. If later we are going to go deep and detailed into data as well as to how the risk management is different between retail traders and professional traders. Retail traders usually take risk per trade about 20 to 50%, while risk risk bearing or risk taken by professional traders per trade is always equal to or less than 1% of their total trade size, and that's where it matters the most. So if we relate it with the same story, let's say trader A started with $10,000 and trader B started with $10,000. Both of them started with the same amount, same capital amount. And if in one trade, trader A might have suffered a loss, then if the risk taken per trade size is 50, up to 50%, then the trader A might have lost $5,000 already. But whereas at the same time, if trader B with the execution with the standard with the institutional trading execution, he might have kept his risk appetite risk ratio uh, only at 1%, that is $100, uh, if we compare it to $5,000, which trader A might have lost. So there's a huge difference between $5,000 and $100 of loss because of risk management that is set by trader A and trader B, because just because of the strategy, just because of the execution discipline which trader B as a professional trader has and trader A as a retail trader who is playing just like gambler on intuitions, on signals that is received on YouTube, on Twitter. And then comes the factor which is one of the most dominant or one of the most fastest growing factors in trading, that is automation. Since 2005 we discussed the chart from yesterday, how trading automation has evolved from 20% up to 80% in 2025, how automation has took over trading industry in last less than 1 decade. And with this automation, the retail traders failure of retail traders as we compare to institutional traders is a there's a huge difference between success rates in retail traders versus professional traders. So these are the key reasons why institutions win, because they operate with frameworks, and retail traders, they suffer losses because they do not operate with frameworks. They operate with intuitions. And if we deeply understand the trading decision tree of a life cycle of a trade, how trades are executed and how it should be executed, and why professional trading is systematic, it is very easy for us to understand and then judge whether the differences and the reasons, the problems that we discussed yesterday were correct or not, why retail users always lose money, and whether this understanding and whether this pattern of retail traders losing money is correct or not. So, okay, we we understand the trade life cycle first from market observation. So initially, before placing a trade, before getting into the trade, professional trader desk uses the structure, and retail traders often skip various features, various strategies or life cycle processes which are very essential. So initially starting with market observation, or you can say the market survey or understanding of the market, basic idea about market prediction of the market, which lacks in retail traders, but which is very apt, very accurate, and to the point with professional traders. Then the identification of signals. Whatever the market analysis professional trader has received, over that the signals are built and the direction of market is judged and defined. On the definition of market direction, on the judgment of the signals, the idea, the decision of whether to go with the trade, whether to go with the particular asset to bet upon or to trade upon, uh, decision part starts for the trade. And when decision part starts, the analysis of the risk definition starts. Risk, as in professional traders, they don't operate more than 1 to 2% risk per trade, while a retail trader goes heavy duty with 20 to 50% risk per trade. And that's how there's a huge difference between strategies of a retail trader and a professional trader. And then comes the next factor, that is decision of position sizing. What size of position should be taken? If it is position in bull run with Bitcoin, Ethereum, or some uh, fast moving, heavy crypto, or an asset which is fast growing, in which there's a huge difference of price, everyday difference in the price. When Bitcoin trading is very volatile, then the price difference in Bitcoin every single day is close to $4,000 to $5,000 when the trading is too volatile. And on the basis of this analogy, on the basis of understanding of the market, there is position sizing of the trade, which algos, which professional traders, they do it with a system, with the framework. And once the position sizing is defined, then comes the part where execution takes place. And these are, um I would say, hidden decision tree behind every trade. When it comes to professional trading, when it comes to retail trading, a retail trader does. So position sizing, after position sizing, there is execution, and post execution, there is post trade analysis, and post trade analysis, there is monitoring of the trade. How do we manage the trade? And then post monitoring the trade, there is understanding, there is planning of the exit strategy. And whenever all these frameworks, all these decision tree pointers, they meet, a successful trade is executed. And what retail traders do, they often skip risk definition and position sizing of the trade, because they trade with emotions, they trade with intuitions. So this is a very common mistake that a retail trader does, because he lacks the system, he lacks the automation in trade, he lacks the tool, the particular software or tech that enables, that helps a retail trader to set a strategy to trade and observe the market, and then identify and then define risk, then do the position sizing, and then go for execution, and then monitor the trade, and then formulate a exit strategy. This is not manual work. From 2025, this is all automated, and this is automated right now. More than 90% of the professional trades are now automated only. And that is the reason why, that is the sole reason why retail traders, they lose money, they are still losing, and they will still lose money, keep on losing money if they don't automate. And that's why we are here. That's why we build the product, to basically give a safe space, a strong place to retail traders, so that they get this kind of structured environment to trade. So now we come to the risk reward framework. This is the most fundamental understanding, and I would say this is the most important understanding of trading that retail trader lacks. This is also called the casino principle of trading. This is a risk to reward concept. If there is a risk of $100 and the target is of $300, the risk reward ratio is 1 is to 3. And uh, if I tell you something very surprising, you don't need to, retail traders do not need to win most of the trade to be profitable. Even with a 40% or 50% win rate, a trader can still make money. This is the casino analogy. So casinos don't win because they predict every outcome. They win because they have a small statistical edge over thousands of events. And professional traders, they operate the same way. They operate like casinos. So they operate with the small edge, that is the statistical edge, which is always there. And that is the design of the market, that is the framework of the market on which they trade and they understand, and it's all automated with algos. Today, we are going to discuss deeply about algos. So, everybody understood the risk reward framework? Shall we move forward? Or if you guys have any confusion or doubts, just raise your hand. I will explain once more. Okay, not a problem. Cool, cool. Let's go. Then we see the profitability analysis of trades and the post profit, that edge on which uh, professional traders they trade, it comes from structure, not prediction. And if we look at the profitability analysis of taking risk or then going without taking risk, we see it clearly that it is the structure that matters, not the prediction of the price that matters. And structure comes with the defined infrastructure, defined technology, and defined trading discipline which professional traders they have, and which is obviously missing in uh, retail traders. Then we understand about the position sizing models. Here we will see clearly the risk per trade, which is position sizing, I believe, is one of the most significant factors, in deciding what trade to, what position to go with for particular trade. Same story if we take with the two traders, trader one with retail trading strategy, trader two with professional trading strategy. Trader A trades with intuition, trader B trades with algo, with structured executed system. So trader A risks 50% per trade and trader 2 risks 1% per trade. After five consecutive trades, trader 1 gets accounts destroyed. But trader 2 is still operating normally because he or she did not take risk more than 1%. That's very clear. So if we look at a trade of $10,000 size, portfolio size of $10,000, where risk per trade is $100 for professional trader, which is 1% of the portfolio size. At the same time, retail trader, which is trading with, often trades with 20 to 50% risk um, per trade. They tend to lose money faster than professional traders who are trading with 1% or less than 1% risk per trade. So this is one of the most evident or one of the most uh, prevalent reasons why positioning sizes determines the survival in the trading industry. Now let's understand the automated trading systems. It's time for us to understand deeply about automated trading systems. We understood why people lose money, why retail traders they lose money, why retail traders they suffer losses, why professional traders they win, why professional traders operate with a system, how um, significant it is to operate or trade with a system with an executive strategy, and what kind of systems. Now we will learn about the kind of systems which professional traders they use, they operate with. So we will first understand the rise of algorithmic trading from 2000 to 2005 to 2010 to 15 to 20 to 25. Slowly, gradually, the automated trading or algorithmic trading shifted, or the trading shifted from manual phone calls to mobile trading to computer trading to applications to automation now. And then machines slowly and quietly took over the financial markets. So most of the global markets are now dominated by algorithms. For example, hedge funds, market makers, quantitative trading firms, and some hedge funds no longer hire traditional traders. They hire physicists and mathematicians and tech guys because trading is now data science. It is very simple for us to understand why these trading houses they only hire tech representatives, engineers now. They do not hire traders or financial experts anymore because trading is now the tech game. Now we will understand one by one the most dominating algorithms in the market, and we will deeply understand what are these algorithms and on which principles these algorithms work, and we will understand the whole trading ecosystem, how it is dominated by algos and what these algos actually do. Okay, this is the distribution of algos with by strategy. Why this algorithm by strategy is dominated by trend following algos, we will understand. So first, we will try to understand the algorithm type first, that is the um, trend following algorithm. Whenever there is movement in market, whenever there is some news, there is some activity, there is some geopolitical decision, there is some uh, disruption, there is some attack, there is some news, global event, there is some um, Bitcoin movement, and there are reasons behind Bitcoin movement. And if we look at the entry and exit signals of Bitcoin for couple of days, a couple of 50-day average in from January to August last year, we can easily see the Bitcoin price and 50-day average of entry and exit signals. When price crosses 50-day average, and people sell it when it falls below. So retail here in this trend following algorithm example, what retail traders might have done is when they bought Bitcoin and it has gone low, then they might have sold with the movement of the market, and that's where they might have suffered loss from April to June. And in this trend, they might have lost on the BTC price, and where professional traders might have entered in May and might have exited in June or July and might have got more profits than the retail traders. So this is where the basic line can be drawn as a contrast between professional traders and retail traders, and understanding of the trend following algorithms can be easily done. So then is the next strategy, that's mean reversion strategy. That's totally dependent on the market revertibility to original position when some event happens. So these algos, they work post market reaction. Let's say I will give you an example of recent Bitcoin movement. I think last week Bitcoin touched $74,000, and post Bitcoin touching $74,000, it reverted back. It actually corrected the whole market. And this reversion strategy, this algo which work on market reversion strategy might have worked really well in terms of placing the trades. So professional traders, they not only trade with trend following algorithm, they also trade, or they also execute trades based on mean reversion strategy algos, which provide signals, which provide them guidance, which provide them um, advices to place trades when the markets are being corrected. Once they go up and the downtrend follows, to correct the whole you know segment of the market. So, and then there is algorithm performance framework. So how algorithm performance frameworks are being set? We all have used pi, and we all have understood how pi worked, how high frequency traders they worked. Um, we all understand the Sharpe ratio, and these are the matrices on which the algorithm performance framework is judged. The Sharpe ratio is risk adjusted return, and ideal value of Sharpe ratio is usually less than 1.5%, and max drawdown is the largest loss that these algos they undergo with, and that's uh, around 20%. Win rate, that is success percentage, that is always more than 50%. Then expectancy average profit per trade, that's always positive when it comes to these algos. So this gives us a clear understanding as to these algos, they always win, and they always uh, lead to success. Now let's understand the infrastructure behind these algorithms which are built to win. If we will understand the infrastructure behind these algos, how they actually work, how algos they work, it is the automated trading stack on which these algos they work. So let's understand what happens behind the curtain back, how these algos they work, and how the infrastructure layers within the algos they work. So first, market data is streamed and the data feeding happens. And then with this data feeding, there is there is signal engine that is associated with the data that is fed in the system. And there at the signal engine, the strategy logic it runs, and whether this information is fetched by market trend, this information is fetched by market reversion strategy, whether this information is fetched by uh, okay, liquidity provision process. This information is fetched by market making process, arbitrage, or it is mean reversion. So all these execution, all this understanding of a trade is determined at the signal engine of the algo, where the strategy logic it runs. And then it comes to the risk engine, then the churned out number of trades, or you can say qualified number of signals, they enter into risk engine. Risk engine actually protects the capital of the trader and the capital which is at the stake of particular trade. And then post risk engine execution, post risk engine determination whether the trade should be executed or not. uh, Algo actually takes the particular trade sample to the execution engine, where the trades are being executed and where the orders are being placed. Then comes the monitoring system that tracks the performance of particular trade and trading algorithms. They're simply software pipelines which execute trades on these principles, these defined principles, so that there is no error and there is no chance of error whatsoever situation comes. And there is proper monitoring, and post that monitoring, there is planning of exit as well at the same time. And exit planning goes on and on post the trade execution. So the moment trade is executed, exit planning begins. And that's why there is monitoring by these algos, when to exit, how to exit, until what extent the exit should be planned. Retail traders, they lack this. Especially the exit strategy is something that retail traders they suck at. So, and then if we look at the behavioral trade design, the behavioral economics of trade, human cognitive biases on uh, which actually impacts the analysis of the trades. So what happened? We will draw a comparison between the retail traders and professional traders with these impact analysis. So loss aversion, the fear, the um, s- um, being scared with the loss, the aversion of loss is a feeling with which retail traders they back off or they go big. And then comes the overconfidence, which is something that is totally or that's zero in algos, and that's abundant in retail traders. And then comes the recency bias of a retail trader as we compare to the algo, which is not there in the algo. Then there is confirmation bias, whether to place the trade or not, because the algo has always been practicing and has a proper structured layout of placing the trade. There is execution engine, there is risk engine, there is monitoring. So retail traders they lack the process, and that's why there is confirmation bias also, which lets or which always leads retail traders to lose while the algos they win. So this is the loss aversion example. Losses feel 2x stronger than gains, and this causes traders to hold losing trades too long. So whenever retail trader gains $100, if we compare it to the loss of $100, that's more painful. And the reason uh, of this pain, and due to this pain of losing $100, retail trader they even lose more because of the uh, pain that caused the last loss on the particular trade, and that's why they start aggressive trading, and they tend to uh, ignore the risk per trade, and that's where bam the accounts they get. Let me come back to the execution discipline and the destruction of accounts. I have to go to yesterday's document where I gave the example how people they lose money and then the accounts get blown away. So account blowing with the retail traders is more because of the behavioral trade design on which the human psychology works when it comes to trading, and the aversion of loss is one of the biggest, most significant factors behind the gains and losses. Then there is over trading problem with retail traders, and something which is absolutely not there in um professional traders. So retail traders they think more trades means more profit, and they also think higher frequency of trader trades means Higher number of trades means higher losses, higher profits. But this is not the case. The more trades uh, you execute, you are more likely to face more losses because your risk appetite, your ability to understand or to measure the risk is not there, is missing. And that is the reason why retail traders, they lose money, they end up losing more money as we compare to the professional traders. So more trades means more profit is bullshit. um, High frequency, high number of trades means higher losses is something that is more prevalent in retail trading. Then we understand about the behavioral design patterns. To understand behavioral design pattern, we need to understand the designing pattern around human behavior around trading. So to set whether to set stop loss at what percentage, at what level there should be stop loss, then risk limits. I will repeat and say it again. The understanding of executing trades at a risk limit, and then position size constraints in retail traders, then structured execution, which is missing. And these are all the reasons why there is destructive, these are the destructive trading behaviors of retail traders. That's how the retail trading mindset is built. And on these reasons, retail traders, they end up losing money, while professional traders, they end up trading seamlessly and they consistently trade and trade. Now let's, after understanding the patterns, after understanding the problems, after understanding the structures, why structure is necessary, why pattern is necessary, why executing engine is necessary, why there is a trading discipline that is required to trade, we will go on our platform. Um, um, what is coming with our platform and why we built this platform, and what is the strength behind our platform. Then we will come to the hyperliquid architecture overview, why we built on hyperliquid and what kind of strength hyperliquid bring to the DeFi, and what is actually hyperliquid. Today we will go more detail. First, tell me how many people checked about hyperliquid. I asked you guys to check what is hyperliquid and read about hyperliquid. How many people honestly went on internet and checked about hyperliquid? Let me see. Just 10, 12 people out of, I think yesterday we had, okay, no, good, good, perfect, right. It is a very interesting blockchain. It is a very interesting ecosystem, and it's really, really fast and fascinating at the same time. Cool, cool, cool. So these many people, they went to hyperliquid. The reason why we built on Hyperliquid, we will be able to understand and bring more conviction, more understanding about the product. Uh, let's have a quick architecture overview of Hyperliquid. So Hyperliquid consists of three uh, uh, major layers. Hyper BFT. This is the blockchain layer of the Hyperliquid. This is the core consensus layer of Hyperliquid, which is responsible for validating and confirming the transactions. This is a non-EVM BFT layer of Hyper. And then it's Hypercode, the trading engine of Hyperliquid ecosystem, which handles the order books, on-chain order books, and executes the market orders. Who remembers how many trades are executed on Hyperliquid every single second? Yes, Rajiv ji. Today is your birthday. Tell us how many trades are executed on Hyperliquid per second.
200,000.
200,000 trades every second are processed on Hyperliquid. That's freaking crazy. I think, and it's so seamless. It works like a website. Uh, I suggest you all to go and use Hyperliquid just once, just to test, just to see how fast and seamless Hyperliquid ecosystem. It's DeFi, it's self-custodial. Your funds are in your custody. It's completely DeFi. Whenever you will go and trade on Hyperliquid, you will see Binance like trading experience on Hyperliquid. Then comes the Hypercore, which is the trading ecosystem. And then Liquid ecosystem has Hyper EVM contract layer, which is smart contract layer, which is uh, openly interactable with EVM networks that enables programmable financial applications. So you can write and develop smart contracts with Solidity on Hyperliquid. It's very much tech friendly for the developers to deploy their smart contracts, DeFi apps, dApps on Hyperliquid, since it is Hyper EVM, which is also I will discuss later, which is unified, which has unified liquidity with Hypercore and Hyper EVM. There is single liquidity. It's not like cross-chain liquidity is divided in Hyperliquid. The cross-chain liquidity is single in Hyperliquid, and that is the reason why the cross-chains trades are executed very fast. If you all remember the problems that we faced while building Boomerang, while executing trades from one DEX to another DEX, we were using aggregators to understand the path, and then aggregators gave us the path. On Hyperliquid, this is not the case. Interchain trades, EVM to Hyperliquid trades are so seamless just in a click. And on our tool, you will be able to execute hundreds of trades within, I would say, few minutes. You will just click, 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 and you'll be able to place hundreds of trades. And with leverage, I mean you will get up to Hyperliquid offers 50x leverage in stocks, in commodities, in crypto. So Hyperliquid is a super Herculean infrastructure, super Herculean ecosystem in which there is, which is a layer specially built for trading. Yesterday I explained. So these are the three layers that create high performance trading ecosystem. Then we understand Hyper EVM layer, programmable financial layer of Hyperliquid, on which the programs are built. The um, Hyper trading engine is built, or the EVM apps are deployed, the smart contracts are deployed. So this is the smart contract layer of the Hyper Liquid, where developers can build DeFi protocols, trading bots, financial apps. And Hyper EVM is Ethereum compatible layer, meaning the developers can use existing tools to build. So, and financial innovation can be built directly on top of trading liquidity. So this is a very unique infrastructure benefit with Hyperliquid that enables developers to build directly on trading liquidity. That means there is a huge, okay, financial application. Let's go to an AI and ask, okay, somebody go on AI and check what is the liquidity on Hyperliquid right now. So let me go on Gemini. We will ask,
Eunice?
wait, I think.
Yes, hi, Chavez, how are you? Yesterday, when I look at the liquidity, was close to $500 million.
So check.
TVL.
Mhm. So we check the TVL, it is around 500 million. And let's check the trading
Trading volume.
volume. It will be around billion, I believe. 5 billion to 7.5 billion, 24 hours with perpetual. So it's a massive trading engine. It's a layer one for trading. And 24-hour trading volume is 275 to 400 million in spot, I believe. So, and hyperliquid token is also, I believe, under 50 on coin market cap. There is macro volatility of crude oil also processes $100 per barrel traders are using. So it is stock market, it is commodity, it is crypto, all it at once, all in one. Hyperliquid is a crazy trading engine. This is the reason why financial applications are built on Hyperliquid, and that's the reason why we built on Hyperliquid, because we wanted to provide, we wanted to give you hand over to you a automated trading game in your hand that you were missing on, and that financial professional traders they always had their hands on from the very beginning. So these the ecosystem supports wide range of applications, perpetual trading platforms, spot exchanges, lending and borrowing protocols, stablecoin systems, vault strategies, governance systems, cross-chain bridges. And these applications, they interact directly with hypercore liquidity layer. Why hyperliquid matters? Hyperliquid solves key limitations of traditional blockchain trading systems. It solves the challenges of low transaction throughput. Uh, Even if you give billions of dollars of transactions to Hyperliquid, it won't collapse or it won't fail or it won't slow down. The speed is the key in Hyperliquid. Then there is no fragmented liquidity on Hyperliquid. Hypercore and Hyper EVM liquidity is not divided, it's one. That means if you operate on chain on Hyperliquid, if you operate cross chain on Hyperliquid, it's one liquidity that balances. That's why there is trillions of dollars of trading volume every single day on Hyperliquid. Then there is no challenge of slow execution of trade. You'll feel like you're clicking on a website. You'll feel like you're just making a click on your cell phone and your trade is executed. And there is no problem of high slippage. In fact, our product is gas free. I'm giving you hints from now. It's built on Hyperliquid and it's gas free. There is no gas fee. It is totally entirely built on Hyperliquid ecosystem and it has zero gas fee. So Hyperliquid overall provides high performance execution, transparent on-chain trading with on-chain order books, integrated financial primitives that are that are structured on Hyperliquid, which gives safe place to developers to code on and to deploy their apps. So it is capable of supporting global financial trading activity, be it crypto, be it stocks, be it commodity. And how next generation trading platforms are built, we will discuss key technology components which are required, which are most essential in building next generation automated trading platforms. Execution engine of the platform. So this is what we kept at most importance at the fast trade routing of the platform, the execution engine, which is the most critical part of the trading system, uh, which is required, which is futuristic, and which we kept at most importance at. Then the risk engine. We understood the difference between trader A and trader B because of the risk determination. Trader A lost, blew up his own account, whole account, and trader B kept on trading, kept on consistently making profits because the risk understanding risk determination was accurate. So our platform has a strategic, well-equipped risk engine that protects your capital, and that we have kept critical priority at. Then the automation layer where there is strategy execution like an algo. You all are going to become an algo, trade like algo yourself. The strategy execution in our platform is at high priority, in which we built the liquidity. So this automation layer is well driven, well managed at Hyperliquid, and liquidity layer, well, a great, huge, deep liquidity provided by Hyperliquid helped us deploy the product on Hyperliquid with no such crunch, no such scalability challenge of liquidity on our product. So, after understanding what Hyperliquid is bringing, what we kept utmost importance at, let's understand why infrastructure it matters when it comes to building trading applications or the trading tool that we built. So, advanced level trading system um, is always built, and when it is successful there is large trading volume, there is huge trading volume, and which has a good user retention percentage, and there is a huge revenue per person because users they trade in volume, and there is scalability in the system. So platforms with better infrastructure, they generate bigger revenue and they retain the users at the at more percentage, more rate for a longer period of time, and there is huge trading volume. So after keeping all this in mind, we built the product, we layered our protocol in such a way that it has ability to support huge trading volume, and which is going to help push retain the users, and revenue per user is also going to be high, and that lets us operate the product for a longer period of time because the product is making us huge amount of revenue and higher volume, higher user retention, higher revenue per person. What comes next is the next episode that we are going to cover tomorrow. It is going to be about future of automated trading infrastructure that we will discuss upon, and this trading infrastructure that we have built already, we are going to discuss. So, as we discussed about today deeply about financial markets and undergoing massive transformation because of algos, because of the attention of these tools towards retail trading, manual trading is being replaced by the systems, and systems are powered by infrastructure, and infrastructure determines who wins. So, in the next episode, we are going to learn about liquidity architecture, execution optimization, on-chain trading infrastructure, and how decentralized trading systems they scale globally. And then this explanation will help us move one step closer to revealing the platform that we have built. So thank you so much for being here. And I think I did not take a lot of time today. I hope I won't take a lot of time tomorrow as well. We finished, I believe, in 1 hour today, right? Carl, I'm being mindful of you guys going back to bed. So, yes, not taking a lot of time.
Amazing.
Going back to bed. I just got up early, that's all.
Mhm.
Yeah, it's early for him, isn't it? He's just getting up, seeing the sunrise.
Mhm. So, tomorrow,
Chavez, another incredible session. So much information. I'm going to have to do some serious furniture moving around in my head to fit all the additional information in. Fantastic. I don't know if you want to take any comments from the panel.
let's take it.
Yeah,
So,
we might as well start with Carl.
but before that, because most people will go, let me announce tomorrow is Sunday. We are going to cover next automation techniques, liquidity architecture, execution optimization, on-chain trading infrastructure, decentralized trading systems, how they scale globally and everything. And post that, we will reach on Monday. Monday, we are going to do revision of Friday, Saturday, and Sunday, all 3 days at once within 2 hours. I will try to finish all this within 2 hours on Monday. And Monday, we will collect all the emails of the people who will be present on Zoom on Monday, and we will whitelist all of them to the product. So while we train for the product, we learn for the product, we go till the launch of the product. I will make sure that everybody who listens to me, everybody who gets trained for the product, uses the product and gets to learn deeply about the product. How to use the product, how to maximize the profitability, how to win in maximum number of trades, and how to make more money. And to trade on the uh, tool, on the product, we will give you a demo trading amount of $10,000 to play with. So every whitelisted user on Monday who comes and joins the Zoom on Monday will receive $10,000 demo trading amount in their wallets on our product, and they will be able to execute number of trades uh, using the trading engines that we have built for you. So it's going to be fun to learn while making money, while understanding the product. And I will make sure that I will cover everything within 1 week, and I will make you all a pro trader. I would say HFT in 1 week. So you all are going to be in algo within 1 week, within next 1 week. So get ready, learn every day, understand every day. And this learning, this understanding is going to help you professionally use the um, product we have built, and can't wait to reveal the product, the name, the functionalities, the features. Now you understand it is built on Hyperliquid. It will be very fast in terms of execution. It will be very deep in terms of liquidity. It will be very much scalable. There will be no challenges of executing the trades. You can bring millions of people in the ecosystem and they all can come and trade, because trillions of dollars are being traded every day on a Hyperliquid. So we have gone deep down to the core of the trading, and this one is really really crazy. This is going to make you go straight into sleepless nights, because you are going to recruit aggressively post the launch. And the launch, I have planned to launch earlier. The product is ready. We are trading already. We have 18, no, 22 traders on board in our team. They are all trading. They have made shit ton of money while testing the product, which is really, really crazy. You will see the stats of their trading, which they have done recently, and it's really, really crazy. I have made a lot of money while testing the product. I was today testing the demo version to understand the logics, to understand the market movement, and I made like within seconds a couple of hundreds of dollars like that in Snap. So it's crazy. It is really, really crazy.
I think
Everything
everybody
is
is
crazy.
eager to get out. Just for clarification on times for next week. Tomorrow, obviously, we've said 9 o'clock, but on Monday and well during the week, presumably after UK prime time, should we do 9 o'clock every night?
So Monday, I'm thinking let me mix Vietnam and the global community together. Or what do you guys think? I
I
think
don't know
the
what time
Zooms
that
are
would be.
going.
What time would that be?
Yeah, and then the time difference would be long, but the Zooms are going to collapse because a huge. There are 5,000 people who are ready in Vietnam to get whitelisted on the day one. So they are planning it very big. So we won't have space to invite Vietnamese members. So let's do it separately. Uh, I'm even ready with 10,000 people, not a problem. If 10,000 people are going to join Zoom and they will give their email addresses to me, then I will whitelist all 10,000. Not a problem.
Okay, so what time on Monday then? Monday, Tuesday, Wednesday, what time do you want to do?
Monday, let's see. Let's do 7 p.m. UK time and we go till 9 p.m. UK time
Okay, so
because
do you want to do the presentation first and then you're going to come? Or you
no,
want to
no, no,
do no presentations next week?
no
Ben
presentation.
presentations.
Because I will take more than 2 hours to
Fine.
revise, to reiterate these 3 days. So the new people I know, some people will wake up on Monday to get whitelisted. They will come. So I want them also to learn. I don't want them. I don't want to leave them behind. Make sure that they all understand from A to Z basics of the product, and then probably by Tuesday in the morning, every user will be whitelisted. Then I will provide the link, and then you guys go to the app, go to the product, and you will find yourself already whitelisted and start using it. Then we
No
will do
problem.
on product training starting from Tuesday. And Tuesday onwards, the training going to be easier. It will be more like screenshots. Joe coming, hey, I made this kind of profit. Rajiv ji will be like, oh, I executed these many trades and all were profitable. And some people will come, oh, uh, I got a loss, but not this much. So from Tuesday onwards, the Zooms are going to be more interactive. And I think you guys will start training more than me because you will have conviction, you will have the product insights and user. We will have real user interaction with the product. So that will be easier. So from Tuesday, the whole training will depend on our usage, our testing. And I am planning to push it live within next 5 to 10 days only, the main version post the testing. So within 5 to 10 days, I will train you all with the product and we will launch MVP within that period of timeline.
Okay.
Okay, well, thank you for that, Chavez. I just want to speak to the community. From experience, I can see through those 2 days of presentation, I can see the signals, pun not intended, from Chavez's comments of the things that they've learned from the previous products. I can see they've understood the issues and they've redeveloped around those issues to improve everything for the community. So don't panic is my key word. Just from the Hitchhiker's Guide from the Galaxy, it looks like they have all been putting in the corrections and from the past, and hopefully this is going to just blow the market up.
This is going to blow the shit up, Carl. This is really going to blow the shit. Just wait till Monday. You get your hands on the beta version and you'll be like, what the hell you have developed? How can you do that? It's crazy. Such seamless, fast execution on Hyperliquid. It works like butter.
Honestly, Chavez, it doesn't really surprise me that we're here having this conversation. As I said yesterday, I don't know, I think you'd already left the room. Knowing you as we do now over the years and the time that we've spent together and the type of person that you are, it doesn't surprise me that it probably never really left your mind and it was always there ticking away until you came up with something that would be better or that would have, fixed the issue. So it doesn't surprise me that we're having this conversation, and it is exciting to hear all of this and get all of this education. It's fantastic. Anybody else like to make some comments?
So just bear with me till tomorrow. One more boring session. and then bam, the product.
Okay. Okay, it doesn't look like any. Oh, Eunice. Go on, Eunice.
You can
Yes.
unmute.
Hey. Hi, Chavez. How are you? Listen, I was, I don't know if we talk about this, but when I learned about a hyper liquid,
Mm-hmm.
probably, I don't know, a year
Mm-hmm.
ago, something like that.
Mm-hmm.
I just saw that and I say, wow, imagine if we couldn't have this at the time of Boomerang. This is a year ago, okay?
Uh-huh.
Because I saw the orders was like Binance, you can actually execute
Like
orders
finance. It's
right
better than
away.
finance.
Yeah, it's better. It's in terms of security, it's better than Binance
Yes.
because it's true the Binance doesn't they won't go nowhere tomorrow after tomorrow, but
Mm-hmm.
you still give your asset to a third party. You
Third
know,
party.
here you have the custody of your party. Even if you have to make a deposit, you
Right.
have the custody of the asset. This
Yes.
is alone. This alone is a
Mm-hmm.
huge
Huge difference.
difference between